G'day Gain Squad, the Strait of Hormuz is officially under another blockade, and the smart money knows what moves to make. Your bank account is probably looking good right about now, but you might want to look at what the big institutions are hiding from you. Something massive just shifted in the gold market this morning, and most people are going to miss the boat entirely while it's scaling. Today we're diving into the April 13th to April 16th madness, from WallStreetBets chaos to the global oil price whiplash. We will see why the smart money is dumping big tech for niche AI infrastructure, while gold tests new all-time highs. Quick one first. I'm just a tech-obsessed Sydney-sider sharing my charts, not a financial advisor, so don't go betting your rent money. The big question today, is gold going to smash through $5,000 per ounce before the weekend kicks in? Drop a comment with your prediction, hit that like button, and subscribe so you don't miss our daily Goldie Gains update. Let's see where the smart money is flowing today, because the market's having a bit of a wobbler after those peace talks failed. On April 13th, the US Navy started the blockade, and WallStreetBets has absolutely lost its mind over the war premium in gold. The gold bugs on Reddit are posting memes about to the moon because they reckon the fiat system is looking a bit rickety. Smart money is watching the Degens scream about a mythical day of reckoning for the US dollar as 10 trillion in debt matures. They think the Federal Reserve is trapped between a rock and a hard place, with energy-led inflation ready to explode. While the retail crowd is YOLOing into physical gold moves, the big banks like JP Morgan are calling for $6,300. Goldman Sachs is a bit more conservative, with a target of $5,400, but they're still buying every dip in sight. Ray Dalio is telling everyone that gold is the safest money right now because the geopolitical world order is entering a transition. He says we're in a capital war environment where debt ownership is being used as a weapon against the regular person. Dalio warns that if you don't have hard assets, your purchasing power is going to get squeezed faster than a cold tinny. Now, let's optimize this entry into energy, because WTI crude oil has been a total rollercoaster over the last 3 days. On April 13th, oil prices leaped over 7% to over $100 as the blockade headlines hit the wires. But by the morning of April 16th, we saw oil ease back to $91.30 on hope for more talks. The OVX Oil Volatility Index hit a crazy peak of 80.55, which is basically a fancy way of saying the market panicked. Traders are watching the OVX closely because if it stays high, gold keeps its war premium of about $200. Goldman Sachs says this is a supply problem rather than a price spiral, but that doesn't mean it won't hurt your wallet. If oil stays above $90, the pressure on central banks to keep interest rates high will eventually break the system. Goldman's Lena Thomas says the long-term outlook for gold is significantly skewed to the upside, despite these short-term shocks. When the energy supply chain gets this tight, gold acts as a hedge against the volatility of the peace process itself. Trump's constant threats and flip-flopping with little resistance from within the US government are making oil prices skyrocket at the pump and pumping markets for another gold bull run. Let's shift our focus to niche AI infrastructure, because the Magnificent Seven tech giants are looking a bit dusty lately. Cathie Wood from ARK Invest is calling the US economy a coiled spring, ready to bounce back with massive productivity. She rejects the idea of an AI bubble and says, we're entering the most powerful capital spending cycle in history. Tesla shares jumped nearly 8% on April 15th, after Elon Musk announced a major AI-5 chip milestone. While the big tech stocks are lagging the index, niche players like Equinix are up 36% this year. Equinix acts as a direct proxy for global demand because every AI model needs physical data centers and compute capacity. Cathie Wood warns that a strengthening dollar might eventually suppress gold, but she admitted gold signals are currently extreme. She thinks Bitcoin is a better source of diversification for asset allocators looking for higher returns per unit of risk. But the smart money in the data center space isn't waiting. They're locking in power contracts and cooling systems right now. Companies like Vertiv and Nebius Group are seeing their backlogs explode as hyperscalers pour billions into new infrastructure. The state of AI infrastructure is the bottleneck of the decade, and the market is finally starting to realize it. If you're looking for where the institutional rotation is going, it's heading straight into these physical AI assets. JP Morgan CFO Jeremy Barnum told analysts that while the Middle East is a risk, the deal pipelines remain incredibly healthy. Investment banking fees are surging at Goldman Sachs as blockbuster mergers and AI acquisitions lead the way in 2026. the value of announced deals hit $1.38 trillion, which is the second highest first quarter on record. This flurry of activity shows that the big boys are still playing the game, even if the headline news is scary. Ray Dalio thinks the US is in a public debt bust stage, which will lead to double-digit interest rates eventually. He's betting on gold because it's the monetary asset least at risk of devaluation or confiscation by a desperate government. Dalio's big cycle framework suggests we're in the pre-breakdown transition of the current financial and world order. This is a proper golden entry for anyone who wants to preserve their wealth while the currency gets debased. The BRICS nations are also pushing their own agenda, settling almost all their trade in local currencies to dodge the dollar. Russia and China settled 99.1% of their trade in rubles and yuan this month, cutting out the middleman. While a common BRICS currency is a distant prospect, the slow burn of de-dollarization is a massive tailwind for gold. Goldman Sachs predicts robust central bank demand in 2026 because emerging market reserves are still historically low. They expect central banks to buy about 60 tons of gold per month to diversify away from traditional Western assets. Every time the dollar is weaponized through sanctions, another country decides to fill its vault with the yellow metal. This systemic reshaping of the international monetary system makes gold the ultimate ballast stone for a portfolio. So while WallStreetBets is looking for the next meme, the smart money is playing a much longer and deeper game. Don't let the short-term noise rattle your cage. The structural bull case for gold is as solid as brick house. The market is pricing in a short war, but historical evidence from legends like Dalio suggests that's a risky bet. We need to think structurally about portfolio resilience in a world that might look very different in 2 years. Let's see where the smart money is flowing in the currency markets, because the dollar index is acting a bit weird. The DXY tried to break its downward channel this week, but got rejected near 97.60 as peace hopes rose. Traders are looking for direction as the Senate confirmation hearing for the new Fed chair nominee kicks off on April 16th. If a loyalist is nominated, expect a massive risk-on rally and a sharp sell-off in the dollar, which would be huge for gold. This hearing is the volatility event of the spring, and every gold getter should have their eyes glued to the screen. Meanwhile, the Aussie dollar is holding steady around 0.7127 today. It's mostly just following the S&P 500 like a loyal Kelpie, waiting for a clear sign of Middle East peace. If we get a sustained peace deal, the Aussie dollar could smash through 0.72 resistance and head for the moon. But for now, the dollar remains the preferred safe haven for many, which is putting a bit of a cap on gold's explosive upside. JP Morgan reminds us that the dollar's dominance is unlikely to be challenged in the short term, despite all the noise. It's the source of international economic stability, and right now, the world is desperate for any stability it can find. The markets are all over right now, changing by the day, with every policy reversal in the US and Middle East, but the long-term fundamentals are still heavily in our favour. Let's talk about that AI bottleneck again, because data centre power demand is set to grow 220%. Goldman Sachs projects that US data centre capacity will rise nearly 200% by 2030 to reach 95 gigawatts. This massive infrastructure build-out is creating winners in specialised sectors like power management and liquid cooling. Vertiv is a name you need to know, with organic orders surging 81% as companies lock in capacity early. Their backlog has hit $15 billion, showing that the AI gold rush is very much in the physical building phase. Even with high interest rates, companies are issuing junk bonds just to build the infrastructure they need for their AI models. If you want to optimize your entry, look for the companies that are the physical backbone of the digital future. Now, let's check the latest gold price movements, because the V-shaped recovery this week has been absolutely textbook. On April 14th, gold was trading in a tight range between $4,725 and $4,780. But as of the morning of April 16th, spot gold is sitting at $4,830.58. Gold futures are even higher, trading at $4,846.44 per ounce today. We saw a 2% surge in gold yesterday as the strong buy technicals finally caught up with the geopolitical reality. Resistance at 4,835 is being tested right now, and a break there targets 4,900. WallStreetBets is full of legends cheering this move, even if they bought in at the absolute top of the January spike. They're betting that the dumb money on the sidelines will have to chase the price once it clears $5,000. But the smart money is already positioned, waiting for the rest of the world to realise how undervalued gold still is. When the world is at a crossroads like this, gold is the only asset that doesn't have a counterparty risk to worry about. Let's see where the smart money is flowing in the metals ratio, because copper is also looking like a proper powerhouse. Copper futures hit more than 2-month highs of $6.08 per pound on April 15th. Optimism over the peace talks is boosting industrial metals because a reopening of the strait would be huge for global growth. JP Morgan projects a global refined copper deficit of 330,000 tonnes in 2026. They expect copper to average $12,075 per metric tonne for the full year. The copper to gold ratio is sitting at 790 to 1, showing gold is still favoured in terms of fear. But as the AI data centre boom accelerates, the demand for copper wiring and cooling is going to hit record levels. We're moving from the AI investment phase into the AI implementation phase, which is incredibly commodity intensive. This shift is going to create some massive winners in the resource-rich nations that can actually supply these metals. So while gold is the safe haven, copper is the growth play that rounds out a sophisticated gain squad portfolio. The Magnificent Seven stocks accounted for 33.7% of the S&P 500 on April 14th. But collectively, they've lost over 10% this year, while the other 493 stocks are holding firm. Let's check the latest technical levels for gold this morning. On April 16th, gold is showing a strong buy signal with the RSI sitting at 56. That RSI level is perfectly neutral, meaning we have plenty of room to move higher before things get overbought. Our MACD has crossed above the zero line and is sitting at 3.9, confirming a fresh bullish momentum phase. The moving averages are stacked up nicely, with the 5-day average at $4,815 acting as support. We are currently trading above the 200-day average of $4,737, which is very constructive. Resistance at $4,835 is the next hurdle, followed by the major psychological barrier at $5,000. The Fibonacci pivot point for today is 4,830, so keep your eye on that level. WallStreetBets is buzzing about this breakout, with legends YOLOing into whatever gold mining stocks they can find. They reckon the mythical day of reckoning for short sellers is arriving as the war risk premium gets priced in. But Goldman Sachs warns that if the energy supply shock gets too bad, gold might actually dip to 3,800. That's their absolute bear case, but they still think the foundation for a massive surge is already building. Most major banks are projecting gold will end the year higher than where it is today, even after the March correction. The correction has only widened the gap to their targets, making this current price a proper golden entry for the gain squad. To recap, gold has surged to $4,830 today as the Hormuz blockade continues to roil markets. WallStreetBets is betting against the dollar as $10 trillion in debt matures, while the smart money is quietly hoarding bullion. Oil prices are sitting at $91, keeping inflation high and forcing the Fed to stay hawkish for longer. Cathie Wood sees a productivity boom coming from AI, while Ray Dalio warns of a global monetary order breakdown. AI infrastructure plays like Equinix and Vertiv are the new winners as the old tech giants start to show some fatigue. Technicals for gold are a strong buy across the board, with plenty of room to run before hitting overbought levels. De-dollarization is the long-term engine that's going to keep gold prices supported regardless of the short-term news cycle. My big question for the smart money today: do you think gold will hit $5,000 before the Fed hearing finishes? Let me know your prediction in the comments below. Hit that like button and subscribe to be a real gold getter. Keep your positions tight and gains golden. I'll see you at the next close. Cheers.